How justified is this concern?
Well, this is really a byproduct of the tremendous stimulus program that was put together by the central bank, by the Federal Reserve. I was there, as you know, I dissented on QE3, but those of us that pushed back a little bit warned that we were going to create problems by pushing people into new risk parameters. When you hammer rates down to zero and you make it clear you're going to keep things super accommodative for an ultra long time, the financial entrepreneurs in the street and elsewhere in the city are going to go out and figure out new ways to capture risk. And they're being rewarded for it by very low rates. So this is no longer the Federal Reserve in the old-fashioned way dealing with the depository institutions with, quote, commercial banks. There's a lot out there of new innovative products, and I think that's what she's referring to. But remember, we helped create this by virtue of the policies we pursued to stimulate the economy and get it off its back and get over the crisis. So I'm not surprised by this. I think she's making an observational statement. I don't think it's eminent. But I do believe that this is, again, this is one of these byproducts of the policy we pursued, and we should have seen it coming. But it hasn't come yet. I think you need to understand that. The economy's still doing well. The markets are highly volatile because they got so rich and they lost all the vol in 2017. I don't see anything unusual here. But I think it's good for her to raise this because we have to be wary and the regulators have to be fully aware.
You know, Richard, last time we had innovative products in the form of all form of adjustable rate mortgages made by non-bank lenders, but it was really the securitization and the double securitization and the reverse securitization of those products that spread them globally and therefore spread the risk. Is there something analogous to that going on now or not?
Well, I mean, we've seen an enormous amount of leverage being used here because it was an attractive way to do it. It's not just a leveraged loan market, it's also corporate balance sheets and people embracing risk. So, again, I don't think there's anything new here. I don't think there's been, by the way, anything new since 1792 in the Mississippi bubble. It's just that we become more modern in the way we do things. So, yeah, I think, you know, you're seeing some risk built up here. And what happens when rates rise is you pay a penalty for some of this risk. It increases liability at the margin. So again, nothing is surprising here. What it does indicate to me, though, is you probably have a cap on how far the Fed can go. I don't think they're there yet. She also mentioned in those comments that, you know, normally we'd go to 5% and then in order to have some ammunition, in order to shoot that ammunition when the economy turns down. That's what I'm worried about. And that is that the central banks are no longer running accommodative monetary policy. They have yet to put enough nuts in the tree for when the winter comes. If we don't get enough nuts in the tree, that is interest rate increases, you get a downturn, what do you have to turn to? That's going to be the real issue. That's what I worry about long term.
Right. A lot of the doves...
Just to be on a happy note here, by the way.
No, I get it. A lot of the doves, Kashkari and others, say that makes no sense to them. Why would you raise rates in order just to have them ready so you could lower rates later on?
I don't understand Mr. Kashkari. I never have, never will, so I don't understand his comments. But let's face it, the Fed has a job. Its job is to create the monetary conditions to enable full employment and to maintain employment and to push off either deflation or inflation. Well, if the economy eventually will turn, the cycle is long. We're going to break the growth expansion here that's the longest since the Civil War in the United States. But at some point, the cycle turns. The Fed's job is to mitigate that downturn, maintain employment levels to the best of its ability, and we don't have enough ammunition right now in our holster to do so. So that's a counter-argument to what Mr. Kashkari is saying, Mr. Kardashian, whatever you call him, and I'm just trying to figure out the logic of their argument. It does make sense. Excuse me, sorry.
No, that's okay. That's okay. I don't think he's a part of the Kardashian family as of yet. Richard, how high do you need to go in order for you to be comfortable there is enough ammunition, as you say, if in fact we do hit, at some point as we expect, a rough patch?
Well, you got two things at work here. One is they're undoubtedly going to move at this next meeting, which comes up soon, December 18th, 19th. I would like to see them get up to 3, but at the same time, you're reducing the balance sheet, and that gives you some room for expansion. We established the principle of using the balance sheet. It's an orthodox monetary tool now. There's a limit as to how far you can go, and Michelle referenced that in her comments the other day because there's political pushback. but you're reducing the balance sheet. You're also trying to raise rates sensibly, gradually, as painlessly as possible. And I'd like to see us to get to 3+, get the balance sheet down. You've got those two tools. The question is the following. Is that sufficient? What else could you do? And those are the orthodox tools that have now been established. So you want to have them, and I think the Fed's proceeding apace in that direction.